Okay, so we will review the recordings today, and I wanted to show you this certificate that the CFA Institute sent you. They send you in this big thing, go around, and the certificate is really very big. It is 60. So I never saw any such big certificate. So I had received this is the certificate that I received. So when you pass the CFA level 1 and level 3 exam and have this work experience, then you will get this big certificate, which is considered the gold standard in finance. So the certificate looks very impressive. I never saw any such big certificate, though I got many, but none were so big. Okay, so we will study this today.
Sir, they should have given that in a meeting, no, sir? Like
No,
all India meeting.
no, you receive it by mail. You don't get it in meeting. In meeting you are invited, you are presented, but this comes in mail.
Okay.
Yeah, this comes in mail. They don't. I don't know about India, but in I got this in the United States. So I don't know about Indian practice because in India, but yeah, they must be delivering by mail because it is the CFA Institute that the president will sign on this certificate and then he will mail it. So that's how it happens. Okay, let me see if the sound correct because what happens that sometimes I reduce sound is correct. Okay, sometimes I reduce the sound in the night. So, okay, so let's study. It is a review and something new will be there because I will be adding some explanations. So let's see, which we had studied that. Yeah, I will take it from the book that we have four kinds of ratios: activity ratios, which measure the efficiency of companies' operations, such as collection of receivables, management of inventories, and also sales volume. So activity ratio will tell that it is the higher it is, the more efficient the manager is. Now, okay, when we will do that, then I will explain more detail. The liquidity ratio, this measures company's ability to meet its short-term obligations, not long-term, short-term obligations, the liquidity ratio. And solvency ratio is the ability to meet long-term obligations. So subsets of solvency ratio are two. One is equity and the another is long-term debt. So total assets divided by total equity is considered leverage. Means how many times more capital of equity is used. So that's why it becomes leverage. And leverage has both positive and negative impacts. Means if there will be profit, there will be profit leverage times. And if there is loss, then loss will also be leverage times of equity. So what would have been the loss when there was no leverage, and what would have been the gain when there was no leverage? So leverage increases the magnitude of both. And profitability ratios measure the company's ability to generate profits from its resources. It means resources are assets, and then another measure is sales. So when it is measured in terms of resources, then we will have the concept of leverage as well as this concept of profit from sales. It combines both, such as asset turnover times net profit margin. That gives us the return on equity. So Shashwati had asked a question that day, and I don't think I had given the satisfactory answer. So I will give that. I will tackle that question again and give you the satisfactory answer. So let's go to the activity ratios first. That what are the activity ratios? And activity ratios depend on Okay, so you have to compare one thing, that in the same industry, the activity ratio might not be the same in different industries, such as in beer industry, where a lot of accounts means it is good to have old beer. Old beer is valued more and its price is higher. So in that case, the accounts receivable has to be for a very long period. Means the beer will remain in inventory and not the raw material, but the final beer will remain in inventory for 2 3 years. So in that case, either the company keeps that in inventory, in its own inventory, or well, normally breweries will not take that because they need to provide a storage. So in that case, this inventory management will be quite high. I mean, so inventory holding days inventory at hand will be quite high for about 3 years or even 4 years. It can go that high. So in that case, if you are comparing beer industry with steel industry, and then further go to the even shorter period like textile industry. In that case, they are not comparable because inventory turnover ratio depends upon the industry. It has to be as per specific to industry. So, smaller the period of inventory at hand, the higher will be the inventory turnover. Means the inventory has been converted into cost of goods sold or converted into cash. That's what we know. So it is more efficient for a company to convert inventory into cash quickly. And many companies like Apple, Dell, or even Microsoft, these technology companies, they don't keep inventory at hand for two reasons. The Dell model always had negative inventory because what happened that it would you whenever you buy a computer online means because Dell didn't sell computers from stores. You could purchase computers only online. And when you buy online, you pay the money today. You choose the model and Dell assembles that. So Dell would assemble after receiving your order and they will ask for 1 week to delivery. And you would happily agree for that, that yeah, 1 week is the transportation cost. So you don't have to go to shop or to stores. You can simply order online. And in that case, the inventory will be negative for Dell. Uh, and what did Dell do? It simply assembled the computer in its store. And those stores were in the United States, there is this USPS, means the delivery company, like this postal services company. One is government postal service, and the another is private couriers. So the private couriers have their own stores. The Dell guy would sit there, the Dell engineers, and they would assemble in that store and deliver from there itself. So Dell didn't have even inventory at its own warehouse. It used the warehouse of USPS, means United States, or UPS, United Postal Service. That is a private company, or FedEx. That is also a private company that delivers goods all over the world. So the Dell engineers would sit in their premises. Whenever they receive the orders, they would simply order the parts. They will have this very good supply management, means their supplier should know immediately that Dell needs so many computers to build in a week or so, and then they would supply that way. So that way, Dell had almost always negative inventory. It received cash before and then delivered goods later. So you can say prepaid sales kind of thing. So that's why Dell was very efficient computer company, and Michael Dell became billionaire at very young age. So that was his. That was his skill in management. So whenever we have this inventory turnover, we know the average inventory, since it is an income, cost of sales is part of income statement. So in the numerator, it will be cost of sales, and that will be in the income statement the day on which it is being prepared, and then average inventory will be in the balance sheet. So from balance sheet, we will calculate the average inventory, and that way we will calculate inventory turnover. So inventory turnover is cost of sales. Well, it should be cost of goods sold is the better word, because cost of sales and sales cost, they sound very similar, and sales costs are advertisement cost, brand management cost, giving discounts. Those are there, but cost of goods sold is the inventory cost or raw material cost divided by average inventory. Now we will get some value, means cost of sales divided by average inventory, and if we divide that by that in number of days in a period, and that period can be either a quarter or year. So normally it is annual. So 365 divided by this inventory turnover gives us the days of inventory on hand. And as I already said, that these days of inventory have to be compared within the same industry, not inter-industry. Okay, because in some industries it pays to have longer inventory. Then receivable turnover, this one is revenue divided by average receivable. So again, since revenue has come from income statement, so we have to take average receivables. Now, how does it measure efficiency? Means the higher the receivables turnover, the more efficient the firm is. Or we can say this, if we go for days of sales outstanding, then lower the days sales outstanding, means 365 divided by average receivable turnover, means whenever it becomes higher, so days of sales outstanding DSO would be smaller. So that is a measure of efficiency. What about payables turnover? Means again we will take this like, since it is counterpart of average receivables, not average inventory actually. Well, average payable looks like counterpart of a receivable turnover, but payable enter cost of goods sold, while receivables happen after sales. Means when the goods have been sold on credit, revenue has been recognized. In the payables, the cost has been recognized because the company is buying raw material. So that's why here it comes the cost of goods sold divided by average trade payables. Now, what does it mean? Payable turnover, should it be high or should it be low? Which is better? Yogi, what does common sense tell? Like,
Could be low, sir.
it should be low. Very good. Means the lower it is, the better it is, but again under the same industry. So because the company is receiving a lot of credit, means the company is receiving the goods without paying. So if the company delays payment, then if it is a matter of choice, then it will be considered good, more efficient, since the company has good credit standing and the suppliers are willing to supply this company on credit. Hence, the company will not have to borrow funds to pay for accounts payable. So the lower it is payable turnover, the better it is. But then sometimes it happens that the company is getting bankrupt and it is not able to pay back. In that case, it becomes that company is going to be bankrupt. So when you see that payable turnover is getting smaller, then you have to examine whether it is Apple or Microsoft or some company which is struggling in terms of finances. So if a company is struggling in terms of finances, its credit rating is low, in that case, payables turnover, lower payables turnover would indicate that the company is going to close down. So under normal circumstances, the intuition says that higher the payables turnover, the better it is. But then an analyst has to be careful in the sense that whether this payable turnovers are voluntary or is it involuntary. So if it is involuntary, means the company is not able to pay back its dues on time. And
Sir,
yeah.
can you once again explain if days of inventory on hand should be high or low, sir?
Oh, days of inventory on hand. Okay.
Ah.
Inventory turnover, higher inventory turnover is better. Yeah.
Okay, so the
High,
overall value should be lower.
so yes, so it should be lower. So days of inventory on hand should be lower, then it is efficient. And number of days payables, just the opposite, means higher it is, the better it is. But again, you have to see the credit rating of the company, means whether the credit rating of this company is high or not. If the credit rating of this company is high, then higher the number of days payable, the better it is. Means the company is not returning money because it is getting credit. The sellers are are trusting this company and supplying raw material uh, for a longer period, because they believe that, yeah, they don't want to, what do you say, here the power of this company from over suppliers is high, and the power of suppliers is low. So this is often a large company that buys in bulk and then pays them also in late. So the number of days payable, the higher it is, the better it is. So let me type it if you want. So higher is better, yeah. Higher is
Sir, higher
better.
is better for properly rated companies.
Yeah, properly rated company, yes. Higher is better. Okay, let me complete this completely. Then, since you pointed out, so higher is better for properly rated companies. Properly, sorry, for properly credit rated companies. That would make it completely okay.
Sir, for
And
days of sales outstanding should be higher or lower, sir?
days of sales outstanding. This one, this
No, sir.
this days of sales, this should be lower. Look,
Okay.
receivable turnover. Higher the receivable turnover, the better it is. So let me write it. What is better here in the top? I am writing better and sorry, better. And when will it be better? Inventory turnover means average inventory is being used, a smaller inventory is being used, so higher is better. So higher. And then since this one is higher is better, so days of inventory on hand lower should be better, because numerator is 365, but denominator is higher. So it will be better when the days of inventory is low. So here, let me write it like this. So when it is better. Then receivables turnover means revenue is being generated by a smaller accounts receivable, means the company is collecting cash quickly. The company is not selling on credit, or the company is not being aggressive in revenue recognition. So when company becomes aggressive in revenue recognition, revenue increases, but then accounts receivable also increase, because we had seen, no, that some of the companies, they ship the good even though they haven't got the order. And once the receiver complains that he had not ordered, then they give the discount 20%, 40%, and then don't take back the good. So that way, revenue in future period will be lower, but at current, they just earn. So receivable turnover, so higher the same revenue, but lower receivables. So higher is better. Receivables turnover. Then days of sales outstanding means 365, or if it is quarter, then 90 divided by higher. So this should be lower. So lower is better. Days of sales outstanding means a smaller days sales outstanding is better. Payables turnover, lower is better because the company is receiving a lot of goods on credit, so it is getting interest-free money. So cost of sales is the same, but then average trade payables increases because the company is not paying them soon. The company is taking advantage of its high credit rating. So this one is lower, and again same. Lower is better for properly rated companies. So how should I add this? Let me add both these. So let me add this. Yeah. Well, it is opposite. So for properly rated company. Okay. Means better for properly rated company. This has to be careful. Okay. Why did I have this? So that's how activity ratio. And one thing is that it has to be compared within the same industry. For beer industry, it will be the opposite because for them, lower the inventory turnover is better because they can charge premium prices on old beer. So the company deliberately does it. But yeah, of course, the company has to borrow money for putting so much inventory. But well, the interest rate is lower than the profit. They charge premium prices. Now, working capital turnover, same thing. Since again it is revenue, so working capital turnover means average working capital is lower, then it is more efficient. So I should write here lower working capital. Hmm. Lower working, so revenue is the same, but average working capital is lower. And how do we define working capital? Do you remember? Who remembers? Shashwat, do you remember or you don't? The definition of working capital?
It was current assets minus liabilities.
The current asset minus current
Current
liabilities.
liabilities.
Yeah. Total asset turnover, revenue divided by average total assets. So higher it is better. Revenue, what did I do? Working capital turnover, no, sorry, not lower. It should be higher. No, average working capital, lower working capital. So it should be higher. Yeah. Just a minute. I wrote wrong. GHR. Higher working capital turnover ratio is better because a smaller working capital will earn the same revenue. Here also a smaller fixed asset is earning it. So higher this ratio is better, and same here as well. Total asset turnover. So this one is higher, the better. So turnover ratios are like that. So we discussed 7 ratios for a measure of efficiency. Now we go down for liquidity ratios, and then we will go for DuPont as well. Liquidity ratio, the most was current ratio by, means current asset divided by current liabilities is current ratio. And then what? It should be greater than 1. Then it is considered liquid. So, and quick ratio. So quick ratio is current ratio. Okay, current ratio is quick ratio plus inventories. Means because inventories are not very easy to sell. So in that case, quick ratio is a better measure. So quick ratio is cash plus short-term marketable investment and receivable. This doesn't has to be greater than 1. So current ratio for efficiency, this should be greater than 1. That is how it is measured. So let me type it here. Greater than 1. This gives us liquidity of the company. What about quick ratio? If it is greater than 1, it is good. But in that case, what happens that a lot of cash is idle, and the company can earn interest on that, and thus that will reduce the costs. So how much should be quick ratio? There is no standard number, but if it is greater than 1, then the company is more liquid, but that may reduce the efficiency of the company. So it is the choice of the company depending on how quickly it can convert its current asset. Means what current is not quick ratio also contains current. It means how quickly it can convert inventories into cash, or accounts receivable, how quickly it receives, then it can have even lower quick ratio. Cash ratio is whatever cash they have, and this cash includes short-term marketable investment like stocks of other companies, or government bonds, or companies of high quality liquid assets like triple A rated companies bonds, which can be sold immediately. So normally equities are more liquid than bonds, but government treasury market is very liquid as equity. Any bank will purchase it. So So that becomes the cash ratio, cash plus short-term marketable securities divided by current liabilities. So quick ratio, all have this current liabilities in their denominator. Quick ratio also has cash plus short-term marketable investment plus receivable. So this one is accounts receivable. And here, this one is cash plus short-term marketable investment plus receivables plus inventories. So only difference between current ratio and quick ratio is of inventories. Defensive interval ratio. So since it is defensive, it means even if nothing is received, then how long can the company remain liquid? So of course, it will take as cash because these accounts receivables are easily convertible into cash, but inventories need to be sold in the market divided by daily cash expenditure. So this becomes defensive cash interval ratio. Now, let's write defensive cash interval. Again, how much should it be? Well, the problem is that if you have more, then your liquidity position will be higher, but then again your profits will be lower. So that way there is nothing what I would say, that higher the better or lower the better in the liquidity form. It should be that it should be able to meet liquid, and that gives this current ratio greater than 1. So banks are able to finance. Though if it is more than 1, then banks may give interest at lower rates, but then the profits will go down. So does it make sense that, does it cover for the profits receiving loans from banks at lower rate? If it doesn't cover the loss in profits, then the companies shouldn't have current ratio much more than 1. Means they shouldn't have 2. Better than 1 is enough. Cash conversion.
Can
Yeah.
you once again define the defensive interval ratio?
What should I define?
The defensive interval ratio.
Or defensive interval ratio
Yes.
means even if the company doesn't receive any cash, then how long can it survive? That is what a defensive interval ratio means. Means the company has sold the goods, but it didn't receive any cash. So defensive interval ratio is the defense of liquidity of the company. So company has to pay some cash every day. And defensive interval ratio measures the cash measure, cash plus short-term marketable securities plus receivables, which are close to cash, because accounts receivable, you can always ask your borrowers to pay back quickly, and they will pay back. They may ask for some discount, 1 or 2%, but then they can pay back. So in that case, it is equivalent to cash and near cash items divided by daily cash expenditure. That gives the defensive interval ratio. Is it clear?
Yes, sir.
Okay. Now cash conversion cycle. So cash conversion cycle is also called net operating cycle. So cash conversion cycle means when the goods, whenever you purchase an inventory today, when it will be converted into cash. So your expense on inventory today, how long will it take to convert into cash? And that one is calculated of days of inventory on hand plus days of sales outstanding minus number of days of payables. So number of days of payables means accounts payable days. We had calculated earlier, no, that accounts payable days. The longer it is, the better it is. So this one is longer the better, DOP. So let me write it. Longer the better, because you are receiving on credit, and DOH, this one is shorter the better. Shorter the better. So these are actually, let me make it here. These DSO, and these are shorter the better.
Sir,
So
so
yeah,
in total, it's shorter the better, no, sir.
in total, the shorter the better. Yes. In total, yes. Okay, let me write it here as well. So in total, shorter the better. Means if this one is shorter and this one is longer, so total will be shorter the better. Okay, so this one was our liquidity ratio. So the problem is that a more liquid company is not necessarily good for shareholders or good for management or good for employees as well, because liquidity doesn't give return, cash doesn't give return. So the management has to make a choice how much liquid to have, but yeah, it should be more than one. Otherwise, the bankers have their covenants, and then they will ask, and they may impose some fine that you are not maintaining our agreement terms, because covenants are agreement terms. So in that case, the liquidity has to be at least what the banks have asked for, and normally the current ratio more than one is a measure of solvency. So, sorry, is a measure of liquidity. Solvency comes here. Debt, relationship between debt and equity. So, debt ratio is debt to asset ratio. And here, these are balance sheet items. So, you don't have to take average. Yeah, you don't have to
Yes,
take
sir.
average.
Since they are from the
So,
same.
yes. So, this one is debt to asset ratio means total debt divided by total assets. And total assets are total liabilities per plus total stockholders equity. So total assets are on the asset side of the balance sheet, and we know the value is straightforward. Total debt also. Now this debt, what? Short term or long term debt? Total debt will have both short term and long term debt. Sum of interest bearing short term and long term debt. Yes. Debt to capital ratio. So capital is your shareholders equity and plus total debt. What is not in the part of total liabilities means, so what is smaller here than total liabilities? So total debt is total capital is less than total liabilities, because total liabilities include accounts payable as well, and on accounts payable there is no interest. So that's why this debt to total capital is all interest bearing assets, or those assets which require return. So total equity is it requires return, and total debt you have to pay interest. So debt to capital ratio. So total capital is all that capital on which some return is required. And
So debt to capital ratio will always be less than one.
debt to capital ratio will always be less than 1 year. So, well, when the company is closing is bankrupt, then it will be more than one, because total equity has become zero, and the bank also is not expecting, means whatever is the market value of the company, means you have to sell the company. Now there are no buyers. In that case,
total debt will be total capital will be less than total debt.
So
And
so the total value can be is one only now, sir, because total debt by total debt plus total shareholders equity. So total shareholders equity becomes 0. You'll have total debt by total debt only. Right?
okay, so that way, yes,
So the
providing
maximum value is 1.
it should be at least one. That is what you are saying. But that will be only the accounting value. Market value of debt can be less than what debt it is. Means what happens that even if you buy a bond, well, let me have this government security. You bought which is default free. So if you buy a Kisan Vikas Patra in India or whatever it is in which is guaranteed by government of India, it will say that okay, 10,000 is the face value, and you purchase it at discount for 9,000 because it is not paying any interest until maturity, and on maturity day it will be 10,000. Now, or let me say that if it is paying you interest as well, and so it is at par, 10,000 debt, 10,000 this security, market value has 10,000. But what if the interest rate has gone up in the market? In that case, your coupon payment will be less than the interest. So even though this face value is 1,000, but if you go to sell in the market, you may get only 900. Means, okay, sorry, if it was 10,000, then you may get only 9,000 or 9,500. So even though it is government debt, which is default free, because the government of India never defaults, or even US government never defaults on domestic debt. So its value can be less. So accounting value will not be less than 1, but market value can be less than 1. But
So
yeah,
I'm telling mathematically, sir, because it is total debt by total debt plus total shareholders equity.
and
So
yes. So mathematically, that is what that will be the accounting value.
yes.
That will be mathematically means accounting value.
Ah,
So that cannot be less than 1, but it can be less than 1 in the real market. Means whatever the scrap value. Okay. Total debt plus total equity, yes. Now, debt to equity ratio. So this one is total debt divided by total shareholders equity, as the name suggests. So this can be what? Less than 1, of course, because
yes.
when the company is highly leveraged, and it can be more than 1. So when it is more than 1, the company is leveraged. Means when this one is debt to equity, when it is greater than 1. If it is greater than 1, so it says company is leveraged. What I would say, greater than 1 means leveraged company. Let me put it like this. This company is leveraged. If it is greater than 1, then the company is leveraged. Where to put it? Let me put it here. So the company is leveraged if this here it is better. If it is greater than 1, okay, let me put it like this. Leverage I will type there because it is confusing. So if I type here leveraged, so leveraged will show greater than 1. This one is better. Debt to equity ratio. So what is financial leverage ratio? Financial leverage ratio is average total asset divided by average total equity. You don't have to calculate average because both are in the balance sheet. But here the book calculated, and why did the book calculated? Because for the purpose of this reading only. In particular, DuPont analysis covered later. Okay, in practice, period and total asset divided by period and total equity is often used. So the book says that yeah, I calculated only for this study, but period and in practice, period and total asset divided by period and total equity is often used. So what for the, in particular, DuPont analysis covered later. Now, why do we have in DuPont analysis average? Because in DuPont analysis, we calculate return on equity, and return is net profit divided by total equity, and net profit comes from income statement. So in DuPont analysis, yes, average is fine. But when you are not doing DuPont analysis, you will use this balance sheet method. So financial leverage is average total assets by average total equity, or total assets by total equity, simply that. Debt to EBITDA, the name is very clear. Total or net debt, there is a difference. Okay, so means total debt by EBITDA or net debt by EBITDA will have the name here different. Means if we are using net debt, then it will be net debt by EBITDA. Now, what is net debt? Means the company borrowed short term and long term, but this company lent also to others. Means when it buys bonds of other companies, means this company has given loan to other companies, or sometimes the mother company gives loans to subsidiaries. So in that case, but in subsidiaries, well, it will be part of this company consolidated report. Means it has to be given to outside companies, to other company. Then only we will have this total debt divided by EBITDA. This one is important, coverage ratio, interest coverage ratio. And we had discussed that EBIT divided by interest payment. And this interest payment is not effective interest payment, but interest expense, which is not cash interest payment. Okay, which is not. So interest expenses which is not cash, which is not, I should write here, which is not cash interest payment. What happens that the difference between this one is called cash interest payment, means the interest payment can happen first and or even more, or it can be even less. So that will be counted as cash interest payment, but interest expense is accrued interest on total debt. So whenever there is accrued, because there can be deferred interest as a as an asset or as a liability, means when the interest has been paid in advance for that period, then this interest expense will be less than cash interest payment. Or when the interest has not been paid, then in that case interest expense will be higher than cash interest payment. So EBIT divided by interest expense means accrued interest. So interest payment, let me type it another way. Accrued, this one is accrued interest or interest expense. Why not to have it slightly this side? Or, and why not to combine this? Or interest expense which is not cash interest payment. Okay. So EBIT by interest expense is the interest coverage ratio, and fixed charge coverage. So we have interest and then lease payment or rent payment. All these are fixed payments. So in the numerator, if lease payment is added, it will be added in numerator as well, because here in EBIT interest has been added. So that's how we calculate this fixed charge coverage. So whatever fixed charges has been in the income statement, we will add that to EBIT and then divide by that to cover fixed charge coverage. So interest coverage, the higher, the more liquid. If it is higher, means higher the better. We can say for sure, means EBIT is higher, interest is lower. So higher the better. Same with here as well. Higher the better. Okay. So when better? Better. What about this one? Debt to assets ratio. Total. What happens that there is an optimal ratio. only optimal amount debt to asset ratio, total debt divided by. So there is some optimal, because what happens that the more debt increases the riskiness of the company. How? This fixed charge payment or interest coverage payment will become lower. So in that case, if there is more, if it is beyond optimal, then the company will be valued less. Okay, what about this one? Debt to capital ratio. Again, optimal. It has to be optimal one, not higher the better, but it has to be optimal. Not too low, not too high. Financial leverage ratio. Again, this has to be optimal. Optimal is better. Where did, oh, what happened? Just a minute. I will not type it here. Otherwise, financial leverage. No, I will type here. Oh, why it is coming? Okay. Leave it. I will type rather here optimal. So financial leverage, there is mm, okay. So this one should be optimal. And debt to EBITDA higher, sorry, lower is better. Well, again it will be optimal, because what happens that the debt has to be taken, otherwise revenue will be less, so EBITDA will be smaller. So optimal. There is no how to put this debt to EBITDA. Now it is better. Okay. So this one is our solvency ratios. And then we go down to the last one. Well, it is not the last one, because we will go DuPont as well. And profitability ratios are very simple. Gross profit margin, when it is better, the higher the better. So we will have here better. And when this one is higher the better. Gross profit margin. Okay. Let me bring this here. Yeah. Okay. And I will draw better when it is better and as it is. Okay. Then operating profit margin, pre-tax margin, the higher the better, more efficient. So, and how to calculate that? So gross profit margin is gross profit. We know what do we call it? Just gross profit is total sales minus cost of goods sold. That gives us gross profit. So gross profit is equal to, gross profit margin is gross profit by revenue. And so in all this case, since it is profitability ratio, revenue will be there one part, and then the another will be the assets part. So this one is higher, the better it is. Pre-tax margin, again, EBT, it is earning before taxes. So that's why, as the name suggests, operating margin is operating income, and operating income is your EBIT. So let's make it very clear. It is EBIT, because most of the time students confuse. So operating income is EBIT. What does it tell? B. Same. Some analysis use EBIT as the shortcut representation of operating income. Okay. Includes non-operating items such as dividend received. No, this one is removed. This dividend received and gains and losses on investment, they are actually removed. So if it includes, then yes, you will remove it as an analyst. Most of the manufacturing companies don't have that part. So EBIT. And then pre-tax margin is earning before taxes, means interest has been paid, but after interest. So again, this one is higher, then it is better. Okay. Net profit margin, this one also net income divided by revenue. So higher it is, the better it is. And net income can come by lower taxes as well. So it doesn't have to be only through operating income, and it has to be like that. One thing which I wanted to add is that cash flow from operating activities must be greater than net income. So that tells us that the revenue has not been recognized aggressively. So where should I include that here, or let me include that here. So since it is the revenue, no. So I will add here cash flow, CFO divided by net income has to be greater than 1. Then it is considered healthy and no accounting frauds. Otherwise, if it is mm, if it is less than 1, means the company is not collecting cash, but it is recognizing revenue. Means the management is doing either practicing aggressive revenue recognition, which is illegal, or which is fraud, or the company is what I would say, cash flow from operations, or selling the goods on credit, means the company is having difficulty in collecting its accounts receivable. So both of the things will show that cash flow from operations is less than net income, and both are accounting frauds basically. So this one is for analysis, though this won't be asked in the exam directly, but this ratio will be asked in the exam indirectly many times. Means whenever they will ask you, means the question, CFA Institute will ask the question that they will give cash flow operations and they will give net income as well. And then they will ask that whether this revenue recognition is aggressive or not. That kind of thing they will ask indirectly. But this one will be asked definitely. CFO by net income, if it is greater than 1, then it is good. Otherwise, then greater than 1 is good. Otherwise, but less than 1 is a sign of aggressive revenue recognition. Aggressive revenue recognition. CFO by net income. So these were based on revenue. These profitability, 4 profitability measures were based on revenue. The more difficulty comes here in the operating return on investment. So operating return on investment is, as the name suggests, operating income divided by average total assets. And why did we use average total assets? Yeah, why? Shashwat, you tell, why did we use here average assets? We didn't use anywhere average values, but in this, why did we use average total assets? Shashwat, are you not there? Yogi, you tell then. Okay, Shashwat is there, so I can't hear him. Okay, so we are using average total assets because operating income is part of income statement and total assets are part of balance sheet. So income is earned over the period of time. That's why average total assets has been taken. Then return on assets. A return always is a net income, because if it is not defined, means return on assets is net income divided by average total assets. Return on invested capital. So what is invested capital? Invested capital is total, average total short and long-term debt and equity. So invested capital is accounts payable is not invested capital. Invested capital is on which you must give some return. So effective now, what is this return on invested capital? So which measure of return should we use? Here we have debt, so interest must be part of that, and we have equity, so operating income must be part of that. So that's why you take EBIT times 1 minus effective tax rate, because it is return, so it must be net income equivalent, since there is nothing like operating or EBITDA, etc. So in order to calculate net return, we must deduct taxes. So EBIT times 1 minus effective tax rate divided by invested capital. So average, so this one is average invested capital, and that is the definition of invested capital. Short-term debt, long-term debt, and equity. When all three are added, that becomes invested capital. So another way of measuring is this one was measuring through EBIT. What if you come up from down? Here we have net income given. So we take net income, and in interest, net income plus interest plus taxes is EBIT. Yeah. So if we add interest and then deduct the taxes on interest, means interest times 1 minus effective tax rate, that gives us EBIT times EBIT times 1 minus effective tax rate. So that divided by invested capital. So this one is often asked in the questions. These are often asked, and in DuPont analysis we will definitely study. Then return on equity is net income divided by average total equity. So this is the return on equity, net income divided by total equity. And return on common equity, net income minus preferred dividends, because total equity includes common equity and preferred equity. So preferred equity doesn't receive dividends. It receives some fixed payment called, they will have 10%, 8% return that has to be paid on preferred equity, and they are called preferred dividends. So they are fixed, they are not variable. While return on common equity is variable depending upon how the profit has happened. So that's how we are calculating the profitability ratio on assets. So if it is clear, then I go down to DuPont analysis. Now profitability ratio. Well, which one is higher the better now? Okay, let me explain here as well. Of course, this one higher the better net income. So it is return, so all will be higher the better. ROE also higher the better, higher the better. Return on common equity, of course, higher the better. And return on invested capital, higher the, well, there is, all are like that. Here also, this one return on assets, higher return on assets, the better it is. So this one was straightforward. In all profitability ratios, the higher is better. Then we come down to here. Let me see, what was this? This one is return on assets. Yeah.
In the case of Adani stocks, will the profitability ratios be higher or lower? Sir? All the
In the Adani stocks, the profitability ratio is higher or lower. What do you want to say? Means it is higher profitability. Otherwise, the values of Adani stocks won't go that much. But then it is highly leveraged as well. Its current ratio is just above 1, and quick ratio is really doubtful. So quick ratio is quite low. So that's why the default situation of Adani is likely to be very high. So that way it is a risky company. Its liquidity position is risky. And yes, leverage is also high. So I said that leverage has to be optimal. It doesn't have to be that higher the leverage is better. No, only optimal amount is better. So what we are studying, net income by average total assets is ROA. Okay, this we had discussed, but then let's go and see something better. operating income. Okay, ROA, that was the definition, but I wanted to see something more important than this. And let me see. Here. So this comes to the DuPont analysis, overall ratio picture. Okay, let me go for DuPont analysis, because Shashwat had asked a question, and then here we need to learn something new, though we have already learned it. So here we studied that return on equity is net income divided by average shareholders equity. That is what we had learned, and straightforward formula, because return on equity means it has to be net income. Had it been operating return on equity, then it would have been operating income or EBIT divided by average shareholders equity. Now, this return on equity has been broken down. Net income by average shareholders equity is equal to net income divided by average total assets. What does this tell? Times this average total asset comes here, so that both cancel out, divided by average shareholders equity. So what is this average total assets? Net income divided by average total assets means it is the return on assets. That is what we had studied. So return on equity is equal to return on assets times, what is this? Average total assets by average total shareholders equity is equal to leverage. We had seen, no, the formula of leverage is average total assets divided by average shareholders equity, and I had said that it should be optimal. It doesn't have to be that higher the better or lower the better. No, it is optimal, is the best. So return on equity, here it has been broken as return on assets times leverage. Now Shashwat had asked this question, that how to know there, and I will go there. Now what has happened here? One more, further it has been broken, that we had here net income divided by average total assets. Yeah, we had earlier, when we were here, we had what? Net income divided by average total assets. Now we further break it. Net income divided by total revenue times total revenue by average total assets, and this leverage will remain the same. So we came here, net income by revenue is profitability, net profit or net profit or net profitability ratio. So this one is profitability times average total assets and times leverage. So this one is net income by shareholders equity. We can write it like this, return on equity. Let me type it here. So this one is, or return on equity is equal to net profit margin or profitability. Profitability, then times, what is this? Okay, profitability times revenue on total revenue divided by average total assets. What is this? Return on assets. That is what we had studied, no, right now. So profitability times return on assets, and this one is leverage, average total assets by average total shareholders equity. So this one is times leverage. Since we are using leverage here, average shareholders equity, because we are talking with net income. So whenever if we take any statement from net income, any value from net income, we have to use average value on the balance sheet. So we calculated that return on equity is equal to profitability times return on assets and times, it is not return on assets, sorry. What is this?
That is
Because
total asset.
revenue by
Right.
or revenue by total asset. Yeah, not return on assets. Yes, profitability times, it is average total asset. No, so revenue divided by average total
Sir,
assets is, oh, sorry, it is not return. It is asset multiplier, no. But it is revenue by average total assets. So here is the profit, revenue by, yeah, return on total asset. That is what it is. Let's go up. Means revenue by average total asset. No, we had done it right
return
now.
on assets is net income by average total assets.
Net income by average total asset is the same thing. Means what we had done, profitability, no, revenue divided by average total is what?
That is the total asset turnover.
Total asset turnout. Yeah, very good. I had for, yeah, total asset turnout. Yes, very good. Total asset turnover. Yeah, total asset. So what was it? Total asset turnover. Total asset turnover and times leverage. Yes, this one is total asset turnover. Yes. So profitability times total asset turnover, or ATO only. Asset turnover is enough because and times leverage. So that's, yeah, here it is written total asset turnover. Come on, I should have seen it here in the details. So return on equity is equal to profitability or net profit margin times total asset turnover or asset turnover and times leverage. That gives us the break. And this one is really very important. You will have one question directly or indirectly. You may have even two questions in the exam. So this one is very important. Now, the further it was added with taxes. So we have this, how much is interest burden and how much is tax burden. So interest burden was EBIT divided by, sorry, EBT, earning before taxes, divided by EBIT, EBIT. So lower part is in the denominator, it is interest, and here in the denominator it will be taxes. So net income divided by earning before taxes. This one is called tax burden. Here it is written. Yeah. So this one is called tax burden, and then this one is called interest burden, then times EBIT margin, then times total asset turnover, and then times leverage. So once you have understood this part, you will be able to answer at least two questions in the exam. And I am expecting at least two questions, or it can be even three questions, because this DuPont analysis is covering all the ratios. Your profitability ratio, your leverage ratio, which is asset turnover, and liquidity ratio, it doesn't cover, but then liquidity ratio is not even useful for earning profit, because higher the liquid, lower the profit. So liquidity ratio is against profitability. Okay, so now if it is clear, then I go down to that question number, I think 14. So this finishes our ratio analysis. So DuPont analysis is the last one. And Saswat's question was, I am going there. What are the average daily rate? Okay. Now this is just compare. We have already done these. So here was the question, if I remember correctly, question number 14, I think that was, which we had. Was it this one? No, it was the next question, yes. And question number 14, I think, if I remember correctly. Yes. So here is the question. And an analyst compiles the data in Exhibit 1 for a company. A return on equity. So let's write it formula here itself. So this one is net income by average total equity. Net income divided by average total equity. Okay. That's what the formula. And this one is here, it has been increasing. The return on total assets. Now, return on total assets is, it is return on total assets. So what is return on total assets? This we had calculated total income means return sales divided by total assets. No, return, it is return on total assets, so net return, net income. So its formula will be like this. let me write it this side. Return on total assets is net income divided by sales, one part, that is the profit measure. And then, of course, I will have to put sales in the numerator times sales divided by average total assets, So I put it like this. This gives me the return on total asset, net income divided by sales. So what is this net income? Net profit margin. And this one is asset turnover. So this one is our asset turnover. So ATO, total asset turnover is here. So this one is ATO. Oh, so this one is ATO. Okay, so why right here? Let me delete this. So that since we are solving this question, so let me draw this. So this one is our sales by average total assets is, this one is our total asset turnover. Okay. So we see that average total assets, what is the question? Based only on the information above, the most appropriate conclusion is that over the period from 13 to 15, the companies, and our answer was the net profit margin has decreased, means net income by sales. It is telling that this has decreased. Yeah. And Shashwat question was, how can we conclude that this has decreased? But its financial leverage has increased. Okay. So where is financial leverage? Financial leverage is average total assets by total equity. So financial leverage is, so where to write that financial leverage? Okay, so it is telling, let's write the formula of this. So it is telling that, let me write it here. So net profit margin is net income by sales. Net income by sales, then times, what is the increase? But it's financial leverage has increased. Okay, financial leverage we will know. So times ATO, total asset turnover. Well, average total asset turnover, TAT. Should I write TAT? I used to write what? Average asset turnover, ATO. I used to write average assets turnover. So average assets turnover, it should be like ATO. But anyway, let me write it what it is here. Total asset turnover, TAT, and times, what is that? Leverage. Because leverage is your this part. No? Leverage, the definition of leverage is total assets divided by total equity is the leverage. So total asset turnover, no, there has to be return on assets overall. So net income by sales is net profit margin. Then sales by average total assets is our total asset turnover, and then times leverage. That is what we had discussed earlier, which is okay. So what is the question? Shashwat had the question that how shall we know that net income has gone down from the data? So here we see that total average asset turnover has gone up by 5%. So here in this case, we are calculating now. So let me calculate this. This one is 1.05. Where to write this? Can I write here? Let me put it here, and then in the top I will write total asset turnover because it increased from 2 to 201. So this, okay, why not to have it like this? Total asset turnover, which is equal to 1.05. Okay, what is the leverage? Do we have been given? We have not been given. Return on total assets, okay, we have not been given. So we are keeping leverage constant because we have no information on that. Then what has happened here? Return on equity has gone. So this one is actually return on equity, ROE. Return on equity is equal to. So what has happened to profit margin? This one has gone up. Yeah, because we are seeing from here total asset turnover increased from 2 to 2.1. So this one is equal to 1.5. About leverage, how do we know whether it has increased or not? Here it can see that return on total assets has gone down. So return on total assets gone down, but here return on equity has gone up. So how do we conclude that? How do we know that leverage has gone up? Because leverage is return on assets time equity, and return on equity has gone up. So if return on equity has gone up and return on assets has gone down, because it is giving no return on total assets has gone down from 8.1% to 7.9%. So return on assets is how much down? 7.9 divided by 8.1, how much will be? Around 0.975. So this one is 0.9 return. This is return on assets, return on equity here, return on assets. Return on assets has gone down because it is given here, and so leverage must go up because return on equity has gone up. So we are seeing that this has gone up. So if this has gone up and return on equity has gone up. So if this goes down, means this must go up. Is it clear? Shashwat, I want your understanding, because here we have to analyze that DuPont analysis. So this one is giving that return on total assets has gone down. Okay. And return on total assets, what formula had we studied? Is equal to return on total assets is equal to?
The ROA formula,
Yeah, ROA formula.
income upon average total assets, net income upon average total assets.
That is the ROA, return on assets. Net income divided by ROA is, but here we
Net-
are having this total asset turnover. Okay. So let me type that. Here we have this, no? Sales by total assets is the return on assets. So this one is your return on assets. So this one is ROA. Yeah. Sales by total assets. And then total assets by total equity is your leverage. Yeah. So this one is ROA and this one is leverage. So I have already written. Now ROA has gone down. Return on total assets is how much? It is return on total assets is down. So this one is actually not 1.05. It is actually how much? 1079 divided by 1081%. No. So this one has gone down. And how much? Maybe 0.98. This one is less than 1. So this one is negative 0.02. Means 2% lower. Negative 0.02. This one is minus 0.02. But then this must be up, which is the leverage, because what has happened? The end result is higher. What did I explain? So return on assets is sales by total assets times leverage. So return on assets has gone down. So this one is negative. Then this must go up for return on equity to go up. So we are seeing that return on equity has gone up and return on assets has gone down, means return on assets has gone down means the leverage must go up for equity to go up. Is it clear to you or no?
Yes, sir.
It is clear to you. Okay. So we have this return on equity went up because return on assets went down. So leverage must go up. One of the two must go up. So what was the question? So net profit margin has decreased, means return on net profit margin, but its financial leverage has increased. Net profit margin has decreased, yes, but net profit margin is return on equity has gone up. So what is the best only on the information of the most appropriate conclusion is that over the period 13 to, okay, so net profitability margin is net income by sales. So it has gone down. How do we know it has gone down? Because net income by sales is equal to, here it is, sales by total assets time total. We saw that this one was 1.11 return on equity. Return on equity has gone up. How much did it go up? What has happened to me? Why? Okay. What is your question? That day you had asked the question that how to
Yeah,
calculate. Yeah.
I asked the question that financial leverage, we understood how it increased, but why
Okay.
net profit decrease, net profit margin is decreasing, that we
Yeah, net
don't-
income by sales is decreasing. Yeah, net profit margin decreasing means net income by sales is going up down. Okay, so how much did it go up? ROE, return on equity was 19.8% and it increased to 22%. Okay, so this increased by how much? About 11%. Yeah, so this one is 1.11. Yeah, it increased by 11%, means this came up by 1.11. Now, how much did this go up? Total asset turnover was 1.05. And how much did leverage increase? How to know that leverage increased? So leverage has, asset turnover has increased by 5%. And asset turnover, I am trying to figure out that how much did the leverage increase? And can we figure out how the leverage increases? Leverage, so the formula is leverage is total assets by total equity, and that we can find from here. So return on assets has gone down by how much? Return on assets was 8.1%, now it is 7.9%. So return on assets has declined. So if, okay, so sales by total assets has declined and total assets has increased because leverage has gone up. So how to figure that out? Let's do that because this is the last part, so we have to do it. 1.1 was 0.973. And we got that from here. So 0.973 is return on assets. So how much is this? 0.973 means, let me put it minus 2.7. Okay. So if I put this one is 1.1, means 0.11 should be minus 0.27, 027, sorry, minus 0.027. So this one is our return on assets. Then leverage has gone up by 5%. So that will increase us plus 0.5%, means this 1.11 must come from somewhere. So leverage is plus 0.05. And then what else is left? Net income by sales, total asset turnover. So total asset turnover, how much has it gone? Total asset turnover, we had calculated that total asset turnover has gone up. So this I wrote 1.5. How to know how much did leverage go up? So leverage has gone up. Okay, if I deduct this, so net income by sales should go down. No, that is what you are telling, and that is what the book is telling. and we agreed to it. And from here we agreed that, okay, here we had seen that net income has gone up. Yes. Return on total assets is lower, means net income must go down. That itself is the definition of a return. Here we studied no one measure. Let me go. Hmm. Profitability measure was okay. Here was the profitability measure above it. Let me see return on equity definition. This one. So we had net income by average. So return on equity was net income by average total assets times average total assets. Okay. Hmm. Return on asset time leverage. How to calculate leverage? That is what I am trying to figure out. Let's go down a little bit. And that was here. Return on asset is total asset turnover and leverage. So how did he calculate leverage? Return on asset times leverage. So we had, what is the question here? Okay, so just as ROE can be decomposed, the individual components such as ROA can be decomposed. Further decomposing, we can express ROE. So where is ROE? ROE is here. So one of the ROE was profitability times ATO times leverage. Okay, so it is this formula will be used. So here net profit margin. Where is net profit margin? Net profit, how did I calculate 4.3, which can be interpreted as follow. 4.38 times 1.06 times 2. Okay, let me see how had I calculated. The first of all, on the right hand side of this equation is the net profit margin and indicator of profitability. That's fine. But how did we calculate that? Oh, okay, here. So 5.92 is 3.33% times 1.11 and times leverage. So why this given? Using the data from example 14. So 5.92% is equal to 3.33. Total asset turnover 1.11 and leverage is 1.60. What did you do next time? Okay, so we will have to find out here only. So why can't we find it there? 5.92% is return to equity and net profit margin is 3.33. So what I had done here, I had written 3.33, then 1.11 and 1.16 is a function of profitability. The third term is this side of the equation. The decomposition states that a company's ROE is a function of net profit margin, its efficiency, and leverage. Again, the analyst moves. So we have not been given leverage, but how to calculate leverage from that data? Net income by average total is equal to net income. I want to figure out how to calculate the leverage from this data. And how did he calculate here leverage? It was given. Actually, here the leverage is given. It is not that he has calculated. Leverage is already given. So we have not been given leverage. Have you been given leverage? Let me go down. Leverage is given. ROA is given. Oh, sorry. Let me go faster. Here the leverage is given or not? Return on total assets is given, ROA, and ROA is equal to sales by total assets time total assets by equity. So we calculate that leverage has gone up. But here leverage has gone up too. But ROE is actually 1.11. So leverage, how much did the leverage go up? How much did the leverage go up? That is what I want to figure out. It is easy to figure out that it went up, but by how much? This went 2%. Return on assets. So how much is return on assets? This one is return on assets is gone down. So we wrote it minus 0.02. But again, minus 0.02 is return on assets is given here, 7.90. So this part is not really correct. Okay, return on assets is 7.9%. Then divided times total assets by total equity. Okay, so times leverage. Okay, let me calculate times leverage. This one is equal to return on equity. So return on equity is 22%. So ROE is equal to that. 7.9% is the return on assets. So what will I have to do? So how much is the leverage? So leverage, okay, we figured out leverage then. So in this case, leverage is, now I got it, 22%. 22 divided by 7.9 is the leverage. So 7.9. How much did we get it, Yogi? It should be 2.6 or what? Do you have calculator? Or should I take
Sir, 2.78, sir.
2.78? Very good. And now let's go down for year 13. So this one is for year 15, fiscal year 15. We have this leverage. Now for fiscal year 13, FY 13, we have return on equity is equal to 19.8. So we have 19.8 is equal to return on assets is 8.1%, 8.1%, and then times leverage. So what will be the leverage? So times leverage. So what was it? 19.8 divided by 8 point is how much?
2.44.
2.44. Very good. Now we figured out leverage. So how much did the leverage increase? So here, so what is the question? Net profit margin has decreased. Okay, let's see. Let's see. So net income by sales. Now what I will do that this increased by how much? Return on equity has gone up by 11%, and leverage went up by what percent? 2.7
13.93.
times. Very good. Now we got it. So leverage is equal to how much did you get?
13.93.
13.93%. So 1.14. Okay. So this one is greater than, this is the increase. So this increase is 1.19 is greater than 1.11. So this is less than 1.19. Hence it has gone down. So where should I write it? I should post it here. Yeah, hence ROE, hence this net profit margin must go down. Hence net profit margin is down, must go down. Okay, this is my third. Oh my God. My brain was not really working very well. It worked here when I came to calculate. Then I figured out that, well, here is the leverage and we can calculate the leverage. So that's how you can calculate the leverage. And that's what I wanted to explain today, because I was not really satisfied with my explanation in the last class. So Is it clear to you both?
Yes, sir.
So how you will calculate? So you must have that DuPont analysis in mind. So this one question is actually from DuPont analysis. Unless you know DuPont analysis very well, you cannot really conclude like this. So you must know how to calculate leverage, and probably before the exam, I will come and once again explain this. Okay?
Yes, sir.
That would be better. And we may find some other questions in other parts as well for DuPont analysis. So, but I will explain this once again. Right now, I took much longer time because I hadn't practiced it. I had only thought it theoretically in mind. So, because I hadn't calculated leverage, so that's it. Okay, so we stop here today, and then from tomorrow we are going to study economics. That is what you want, no?
Sir, economics would be better or the quant would be better, sir? Which one would you suggest?
You had said yesterday
Yes, sir. Like
economics.
I'm thinking.
Yeah, you had said yesterday, but I can select both. What we can do, we can study economics for 3 days and then quant